Morning and good afternoon, everyone. It is January 22nd, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Macro Strategist. Before we start, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for member to press. If you're a member of the press, please log off and reach out separately. Please also note that this webcast and recordings may be recorded. Today, we have Chetan Iyer, Chief Asia Economist, Michelle Weaver, U.S. Thematic and Equity Strategist, Ariana Salvatore, U.S. Public Policy Strategist, and Sean Nakazawa, Japan Agri Strategist. During this session, you can send a question at any time from the Ask a Question text box. Our global thematics team have published two notes during the last week, including the 10 thematic predictions for 2026 and also the future work survey results. Today, we are very happy to have Michelle to share the key takeaway from the report. And then without further ado, let me pass it to Michelle to share the key takes.
Great. Thank you, Crystal. Hi all. We recently released our key thematic outlook, where we talk about the different key themes for MS research. And 3 of our 4 key themes are going to remain the same as 2025. And those themes are AI and tech diffusion, the future of energy, and the multipolar world. AI and tech diffusion is largely about AI spreading throughout the economy as different companies adopt AI to make themselves more efficient. The future of energy is really about energy security and about powering AI. And the multipolar world is about shifting spheres of influence and the geopolitical dynamics that come with that. And then this year we introduced one new key theme called societal shifts. And that's really an expansion on one of our prior key themes, which was longevity. And this new theme broadens out the longevity theme and allows us to think about the full age range of the demographic spectrum. It also allows us to incorporate some income-based demographic work like the K economy. And then finally, I think one of the most important aspects of the new societal shifts theme lies really in the intersection between AI and demographics, and asks what's going to happen to labor markets as AI augments or disrupts certain jobs and certain labor tasks. In our full outlook, though, we go through 10 different thematic predictions for the year that link to one or more of our various key themes. In the interest of time, I'll just go through a couple of these predictions that are interesting intersections of these different key themes and that are particularly important for the US. So the first one I'd flag is the politics of energy. And this is the intersection between AI, tech diffusion, and the future of energy. Power is still one of the key bottlenecks for AI data center growth in the US. But the politics about powering AI and powering data centers is changing quickly in the US. And consumers across the country have seen their electricity bills rise. And they're increasingly pointing the finger at data centers as the reason for this. I want to really emphasize, though, this is a nuanced issue, and data center power demand is driving consumer bills higher in some areas, like the Mid-Atlantic, where you have a lot of data center growth and you have an unregulated utility market. But this is not the case nationwide, and it really depends on a number of factors, like how many data centers there are in the region, and whether you're living in a regulated or unregulated utility market. But either way, the perception has turned decidedly negative against data centers. And we're starting to see a big increase in local pushback that's causing planned data centers to either get canceled or delayed. This is very much on the radar of different American politicians. We even saw President Trump address this recently. So from the investor standpoint, this is good news for companies that offer off-grid power generation. So these companies would be doing things that are completely not connected to the grid, so there wouldn't be a chance of any sort of consumer price offsets there. So things like Bloom and their fuel cells, so this is looking more attractive. The next one I want to flag is AI-driven labor market changes and the demand for reskilling. This is tied to AI, tech diffusion, and our new societal shifts key theme. AI has the potential to be very disruptive to the labor market. We think AI's impact in workers will really come into focus this year as companies ramp up on AI adoption. We recently published a survey around the future of work and are starting to see that companies are already starting to either reduce or not replace certain headcount due to AI adoption. One concern, though, is that it's going to replace millions of jobs and increase unemployment by an equivalent amount. We don't think that's the case, though. If history serves as a guide, when you've seen these prior waves of technological innovation that were very significant in scope, the labor force does ultimately adapt. So while we think there will be some, AI automation or AI job loss, we do think there will be a lot of demand for reskilling. People are flexible, they're likely to take new roles. So we do think there is investor opportunity in companies that can offer reskilling programs or education programs to retrain workers. Last thing I want to flag before I turn it back to Crystal is we launched an America's thematic focus list. APAC also has a thematic focus list. So that has some of our best single name ideas to express these different themes. But I'll go back to you now, Crystal.
Thanks so much, Michelle. There are two questions from clients that I would like to ask you. The first one is more on thematics, and then because some of the thematic names, for example, future energy and also the broader defense name have had a very good run for the last 12 months. Do you think that growth will still justify the expensive valuations from here? And then I'll ask the next question afterwards.
Mm-hmm. Yeah, so totally agree that some of those valuations are becoming quite expensive, but I think the thematic reasoning behind those categories is still very much in place. So future of energy, yes, those names have gotten quite expensive. I think as we think about this new dynamic of this political overhang for things that offer off-grid power generation solutions, I think those are going to become even more attractive, even though you've already seen a pretty big run up in those names. A little bit more selectivity in the space. So the merchant power generation names, I think those could struggle a little bit more because those are on grid and some pushback could be expected there. On defense, you've seen the U.S. become, more aggressive on the policy front. So while you've already seen a lot of interest there, I think as you continue to hear some of the rhetoric from this administration, that it's still going to be an attractive area, even though valuations have already moved higher.
Thanks, Michelle. And then there's another question more on the future of work survey that you have done. How do you see the regional differences among all the 5 countries that you survey? For example, US had job gains from AI, while the other countries have suffered job losses. So how do you view the differences and then why, and then what is the underlying rationale behind this phenomenon?
I think it's still early days. So I think that's part of the differences is maybe in the U.S. you haven't seen losses yet, but it was also a function of how we set up the survey. So we set up the survey to look at things where we estimated, the most potential gains for AI adoption. So I think part of it could be, a function of the survey construction. But I would expect to see more job impacts across countries as we get farther into the year.
Thanks so much. I don't see any other questions on the line for now. And then thanks so much again, Michelle, for telling us such a late
Thank you.
timing. Thank you. Supposedly we should turn to Ariana, but then I don't see her online yet. So maybe now I will turn to Show to talk about the implications on equities from the Japan snap elections.
Sure. Thank you, Crystal. Actually, there has been many noises in Japan since the beginning of this year. Over the past week, almost all questions from domestic and overseas investors have been election-related and JGB markets turmoil. Last week, speculation about the snap general election triggered a classic reflation trade, so selling yen and JGBs and buying of equities. And in the Japanese stock market, large cap tech and defense related names continue to outperform, a continuation of the so-called Takaichi trade. This was driven by expectations that the ruling coalition would gain additional shares under Takaichi-san as she enjoys strong approval ratings. But beginning of this week, in contrast, domestic demand oriented growth stocks are outperforming, which is a typical defensive rotation. This likely reflects not only concerns about potential FX intervention by the Ministry of Finance, but also the launch of the Centrist Reform Alliance formed by the CDP Constitutional Democratic Party and Komeito. That said, it's unclear how far this centrist coalition can expand its seat count. And regarding this opposition bloc, frankly, there is nothing particularly new about the partnership between Noda-san of the CDP and Saito-san of Komeito. Neither of the party leaders offers a compelling new public image. And in the previous lower house election 2024, the LDP under the Ishiba administration lost roughly 50 seats. The beneficiaries were primarily the CDP and the DPP, Democratic Party for the People, and not only conservative boards, but also unaffiliated voters shifted away from LDP. And in the CDP's case, the proportional representation votes did not change much. So CDP's gains in single seat areas can be viewed as accidental windfall resulting from voters defecting from the Ishiba LDP by the process of elimination. So if voters now see limited differentiation between the LDP and the centrist Reform Alliance, given the Takaichi administration's high approval ratings and its policy agenda, some of those seats could revert to the LDP. So rather than expecting the centrist alliance to surge, investors may assume a return of around 50 seats the LDP lost in the previous election, supported by the Takaichi administration's strong public support. But what about potential market reaction if the centrist Reform Alliance, the opposition bloc, performs strongly? I think initially stronger opposition showing could be viewed as negative for Japan equities due to concerns over policy stagnation or political instability as well. On the other hand, election platforms may not differ meaningfully between the ruling party and the centrist alliance. Both support consumption tax cuts and defense policy enhancements, including discussions on constitutional revision. And the Centrist Reform Alliance proposed using a Japan-style sovereign wealth fund to finance permanent tax reductions on food items, which should require creating new frameworks involving the maybe GPIF, FX reserves, and the BOJ's ETF holdings. In this sense, market reactions may not necessarily be entirely negative, but a clear point of the differentiation is nuclear policy. The centrists support restarting reactors, but are reluctant about new construction or replacements. And they emphasize renewable energy. So electric utility stocks could come under pressure, in my sense. And next question should be why this election matters. This election could be a major game changer and a significant alpha opportunity for event-driven investors, in my sense. As if Takaichi-san's policy direction receives clear public endorsement, the market environment could shift dramatically. As from a strategy perspective, I don't care much about economic policy nor fiscal size. The real issue is national security policy, including constitutional division. As constitutional reform previously never seriously flushed into Japanese markets could become a major catalyst. If revisions include full approval of collective self-defense, removal of Article 9 Clause 2, which is restrictions of non-possession of military capabilities, or reconciliation of the non-nuclear principles, I think defense-related sectors or stocks could undergo structural evaluation. Exporting defense equipment would gain constitutional legitimacy, improving policy predictability, expanding spot opportunities, and lowering risk premium as well. And regarding sector allocation, I think persistent fiscal expansion and sticky inflation expectations tend to favor stock-based business models and increase the scarcity, the value of real assets. With both ruling and opposition parties emphasizing national defense build-up and with geopolitical risks rising in East Asia, Japanese equities could increasingly reflect a security premium. So not only defense-themed stocks, but also sectors with tangible assets, for example, energy resources, materials, infrastructure, trading companies, and real estate developers stand to benefit when geopolitical and inflation expectations increase. I like to, that's a kind of overview on the upcoming snap election. So I'll stop here and pass back to Krista. Thank you.
Thanks so much, Sho. And before we take any questions for Japan equities, I would like to invite Chetan to share his thoughts on the rising worries over Japan's fiscal situation and also the latest viewpoint on whether a stronger RMB will impact rebalancing in China.
Yeah, thanks, Crystal. So, look, firstly, on the Japan fiscal policy concerns, or call it the fiscal risk premium that has emerged in the bond market, just to share our thoughts on that. If I compare Japan with the US, that makes the point much more stronger and clearer. So when we look at the fiscal deficit situation at the starting point in Japan, it's at 0.5% of GDP. And our Japan economics team is expecting this number to rise to 1.9% by the end of 2026. And as long as the deficit numbers are below 2.5%, 3%, public debt to GDP mathematically, because of the way growth and growth dynamic is, it will be actually declining. So that's on the first point, that fiscal deficit in Japan is relatively low. Now, if you compare this with the US is at 5.4%, was at 5.4% in the last 12 months. And we're expecting this to rise to 6.3%. So this is much higher than where Japan is. The second comparison we can make is on public debt to GDP in Japan versus US. So in Japan, public debt to GDP adjusted for BOJ holdings is at 100%. In the US, it's about 113%. And the trajectory is also diametrically opposite. The US public debt to GDP is still rising, whereas Japan public debt to GDP has been declining in the last few years, in fact, quite rapidly, and is likely to still stay on the path of reduction at least in the next 12 months based on our team's fiscal deficit forecast. So those are the two very clear comparison points. And then from the fundamentals of the bond market, the third point of comparison would be what's happening to inflation, because arguably that is another concern why bond yields are moving up. But when you look at the fiscal deficit the inflation trend in Japan, core inflation in Japan, the US style core inflation is what we prefer to look at, because the Japan style core inflation does still includes some of the food items. So if you look at the US style core inflation in Japan, it's running at about 1.5, 1.6%, whereas the US is at 2.8%. And yet, when you look at the term premium or the fiscal risk premium in the Japanese bond market, which can be seen by looking at the gap between 30-year minus 2-year, it's kind of double of what it is in the US. So the gap between 30 minus 2 in Japan is 260 basis points, and the US is at 130 basis points. So we think that the fiscal concerns that the market has is a bit excessive. And we are not worried about Japan's public finances management getting out of hand. So that's on the Japan part. On the China part, there is somewhat different view from what the markets and the investor base is beginning to think about. So RMB has been appreciating, as we've all seen in the last few days. And the question, or some investors are basically asking, is that whether PBOC has changed its reaction function as far as RMB is concerned, and whether it is going to allow significant further appreciation of RMB. In short, we don't think so. We think that PBOC is managing the RMB on a medium-term basis. If you look at it from 2016, it is keeping it in a stable range on a trade-weighted basis. And if you do end up seeing some appreciation of RMB against the dollar, it would be because the dollar has weakened more broadly. So you can appreciate against the dollar on a pair basis, but on a trade-weighted basis, RMB is still likely to be kept stable. Now, with that stable RMB on a trade-weighted basis view, we kind of add to that what our macro strategy team is forecasting on for the dollar. And with their forecast on the dollar, we're expecting that RMB will appreciate in the first half up to 6.85. But we're not looking for even a significant appreciation on RMB on a pair basis against the USD as well, because of our view on the dollar. So that's the conclusion. But now, why are we arguing that RMB will not appreciate significantly from here? The main reason is that China still has the deflation problem. And while deflationary pressures may ease over the course of 2026, the economy will still be in deflation. So as long as you are in deflation, it would not be the most preferred policy for PBOC because currency appreciation will make the deflation challenge and the exit from deflation will be even more complicated. The connected point which a lot of the investors are asking is, would an RMB appreciation help rebalancing, boost consumption because of cheaper imports? Again, on that, we think it's actually going to be counterproductive, even from the perspective of rebalancing, to allow the currency to appreciate. Because of the point that I mentioned on deflation. So if currency appreciates and you increase deflationary pressures, that will hurt the corporate sector margins, and then corporate sector will further cut wage growth, and therefore it affects negatively your consumption path, and in turn the expectations for rebalancing will also be affected. So that's it for me. I'll hand it over back to you, Crystal.
Thanks very much, Chetan. And then I see that Ariana is still offline now. So then in that case, we'll move on to the Q&A session. So the first question is for Shou. How does the rise in JGB yields impact equities in your view?
Thank you, Crystal. I do not think that the rise in JGB rates necessarily shows a severe headwind for Japanese equities at this stage for two reasons. So number one is that Japan's real interest rates remain deeply negative. Financial conditions are still accommodative, and neither corporate activity nor equity valuations appear to be under significant pressure, assuming core CPI stabilizes around its current 3% level. There remains more than a 2 percentage point buffer before the real policy rate turns positive and becomes restrictive for the economy. And the second reason is that Japanese equities remain attractively valued by global standards. I mean, the equity earnings yield long-term rate spread, that's a kind of traditional risk monitoring tool, yield spread. It's much higher in Japan than in the US or Europe. So even with rising long-term yields, the absolute level remains low, and Japan's relative investment appeal is largely intact. So it is premature to adopt overly pessimistic stance toward the overall Japanese equity market based solely on rising interest rates. And in addition to that, some investors show some concern to lifers for their super long JGB exposure. But according to our analyst who covers lifers, many lifers are in practice able to avoid impairment losses by demonstrating both the intent and ability to hold the relevant bonds to maturity. Of course, some lifers may opt to record impairment losses so as not to constrain failer investment flexibility. But even in such cases, he would expect the impact on the income statement or balance sheet to be neutralized by, for example, the parallel booking of gains on the sale of equities. Yeah, that's all from my side.
Thank you very much, Sho. We have another question online. That's for Chetan, because some people they're very worried that about they haven't really built the confidence in the Japan sustainable nominal growth, and then some people attribute the yen weakness to that apart from the fiscal concerns and also the Fed policies. So, Chetan, how do you see the Takaichi fiscal policies? How does it impact inflation, and then what's the view on nominal growth from now?
Yeah, so look, I think the fiscal policy should actually help nominal GDP growth outlook. And in fact, that's what we have been sort of looking at. Both monetary policy and fiscal policy has worked towards making Japan's nominal GDP growth more sustainable. And so far, we've seen that PBOC has been, sorry, not PBOC, but BOJ has been kind of careful in taking up rate hikes in a way that they nurture this Japan reflation story and not hike preemptively. And now we are seeing the fiscal expansion, which will also be supportive of nominal GDP growth. So as such, fiscal policy is giving us more confidence to sustainable pickup in nominal GDP growth. Now, the question is whether currency depreciation is going to force the BOJ's hand to hike aggressively and therefore increase some risks on the outlook of nominal GDP growth. We still don't think that PBOC, again PBOC, sorry, that BOJ will be taking up rate hikes aggressively. We do see the risk of a rate hike coming up earlier than what we were expecting earlier, but it's still not going to be taken up at a pace that runs the risk of reducing the reflation path for or cutting down the nominal GDP growth outlook in a meaningful manner.
Thanks very much, Chetan, and that's super clear. And apologies again that we cannot cover the topic on US policy today, and I will end the webcast here. Thanks so much for joining us, and do reach out to me and the team if you have any other questions. Have a nice day and see you next week.